When studying technical analysis and analyzing price movements through your computer, you will come across three main types of charts: the candlestick chart, the line chart, the bar chart. The candlestick chart gives us the most information and displays price action in the clearest possible manner. The candles allow us to see at what level the price opened and closed, as well as the highest and lowest points, through the upper and lower shadows. The shadows are also known as wicks. A bullish candle is often represented with the green color, and has the opening price at the bottom, and the closing price at the top. The bearish candle is often represented with the red color, and has the opening price at the top, and the closing price at the bottom. The volume of the candle is equivalent to the body of the candle. The shadows, on the other hand, are equivalent to the upper and lower lines, that indicate how far the price has extended in that precise period of time. We will deepen the study of candles in the following video. The bar chart is very similar to the candlestick chart. The bar chart shows the opening and closing price, along with their upper and lower shadows. The only difference between the candlestick chart and the bar chart is the style in which the price is represented. The line chart is different from the previous two, and focuses mainly on the closing prices. The line joins the various points that represent the closing prices. The line chart is very important to be able to accurately plot support and resistance key levels, eliminating excessive price noise. Price noise refers to fluctuations that have no logic and no particular volume, and which could only confuse our ideas. The line chart is also an extremely simplified method in viewing the overall trend of the market. The line chart tracks price history in a very tidy manner, but it is not practical to trade with. It can certainly be a good chart for investors who want to open long-term positions. The timeframe represents the period of a given candle. The main timeframes are the monthly, weekly, daily, 4 hours, 1 hour, 30 minutes, 15 minutes, 5 minutes and 1 minute. The choice of the timeframe relies mainly on your trading strategy. The candle, therefore, represents the movement of the price in a specific time interval. In the monthly timeframe, each candle represents a month of fluctuations. Over the 4-hour timeframe, each candle represents 4 hours of fluctuations and so on. Using a higher timeframe will give you a complete view on the direction of price of a given asset. Lower time frames can confuse your analysis if used incorrectly. The monthly time frame acts as a satellite in space, showing the complete picture of the Earth. While the minor time frames act as if they were continents, states, regions, provinces and municipalities. Essentially, lowering the time frames is the same as zooming into the bigger time frames, for a much more precise analysis of price movement. If you were to move from municipality to municipality, without knowing the direction, you could easily get lost, despite the fact that the destination is close. The same is true in the financial markets. If you only rely on the smaller time frames, without paying attention to the larger time intervals, you can easily get lost. The higher time frames give us a complete mapping of the price movement. It is crucial to always use a top-down analysis, meaning that first you have to analyze price movements on the higher time frames, and then gradually lower the time frames to find the best possible trade execution. We will analyze in detail the top-down analysis in the next videos.